Welcome back to Street Smart. Amazon.com, the world's largest online retailer, reported first quarter earnings just moments ago. The problem, though, really was in its second quarter outlook. Joining us now is Gene Munster, senior research analyst at Piper Jaffray. We run the numbers, and Gene is one of the most accurate forecasters of Amazon stock in the world. We call him a Bloomberg best. Gene, thanks for joining us.
Thank you.
You've only had a few minutes here to go over the release, but immediately, jaws were dropping here around the newsroom. It's not a fantastic release, especially if you look at the big EPS miss in the first quarter and the big outlook problem, the gap between what the company expects and what the street wants to see for the second quarter. What's going on?
The bottom line is it's not as bad as it looks. This is a revenue growth story. If you look at e-commerce in the U.S., it's about 6%, 1% in China, 8% in the U.K. It's revenue growth of the next decade. And they did 38% revenue growth this quarter. The street is looking for 33%. That's the most important point. Most investors know they're investing aggressively into their business, into fulfillment, and that's why those margins are so pathetic. And if you look at the revenue growth, to your point about the revenue expectations for the June quarter, they guided to 31% growth versus the street at 33%, but typically they outperform by about 4%. In other words, is that guidance really implies 35% growth versus the street currently at 33%. So you got to kind of run a filter through all of this and take a step back. But this is still a best positioned company in e-commerce, and despite the massive amounts they're investing, they're doing the right thing longer term.
Well, Gene, so that makes sense why you've got an overweight on it. I'm looking at the stock, though. It's down, or it was down big time initially in the aftermarket. It looks like it's pretty flat right now.
Investors are stepping back and taking the look that Gene has recommended.
And I bring this up. I mean, do investors sometimes they're too short-sighted. They don't realize when a company is investing for the future, and they don't kind of give them a break here.
Exactly, and I think that this is the best case scenario for a company that's investing. And the most important part of the company that's investing is that it has a big secular theme in front of it. And as I mentioned, those market penetration numbers of e-commerce, they're still so low. There's just a long way to go. And so I think that the worst thing Amazon can do right now is to pull back on the spending and the investment. And the good news for them is their spending has delivered top-line outperformance as they just did in the March quarter.
One of the complaints that you hear, one of the concerns that you hear about Amazon, Gene, we heard from Colin Gillis earlier in the program saying that, look, this company sells books, this company sells music, this company sells movies, and this is an area where big bad Apple is going to come in and really what is it, eat their cake? I don't know. In any case, obviously, Apple is huge and unstoppable, right? So if they're in the same business, isn't it worrying to you?
It is. For that segment, that's about 35% of their revenue, their media segment, and that grew at around, I think, 8 to 12% this last quarter, versus their other business, the EGM, Electronics and General Merchandise, which grew almost 60%. And so you can see those two businesses. The bottom line is this, is that that's true. That is a slowly dying part of their business, but the other business is growing fast enough to offset that. And so I think it's a negative, but it's kind of within the models. And if you look next year, the street's looking for that business to be down 2%, but still the overall business growing at 30%. So it's the good outweighs the bad.
Got it. Gene, unfortunately, we've got to run. Gene Munster, everybody, from Piper Jaffray.